the stateless standard. The Justice Department investigated the banking crisis but failed to indict the root cause, the Federal Reserve. The Fed's sacrosanct role in America's welfare warfare state shields it from scrutiny. This is nothing new. During the Great Depression, officials blamed failure of free enterprise rather than the Fed's policies for the 1929 stock market crash. Since its 1913 inception, the Fed has engaged in monetary degeneracy, printing ever-increasing pieces of paper to fund escalating federal warfare and welfare expenditures. Its easy money policies inflate the money supply, causing prices to soar due to devaluation. The Fed then raises interest rates to curb the inflation it created, triggering recessions. Once the recession ends, the boom-bust cycle of easy money resumes, fueled by programs like Social Security, Medicare, and wars in Israel, Iran, and the Ukraine. The Fed's prolonged quantitative easing and COVID-era inflationary policies flooded banks with deposits. With insufficient loan demand, banks invested in long-term federal bonds, touted as safe and liquid. However, as the Fed's easy money drove prices sky-high, it rapidly hiked interest rates, devaluing those bonds. For example, a 1% bond loses value compared to a 5% bond. This caused a double blow. Tech companies withdrew funds to cover losses, and depositors pulled money to chase higher-yield investments. Banks, forced to liquidate devalued bonds at significant losses to meet withdrawals, faced bank runs, leading to the collapse of at least 2 banks. America's original gold and silver coin monetary system, without paper money or a Federal Reserve, underpinned unprecedented prosperity from the post-Civil War era to the early 1900s. Federal bonds were promises to pay, not money itself. The Fed's establishment in 1913 and the shift to paper money in the 1930s have proven disastrous, perpetuating a cycle of inflation, recession, and financial instability. Thanks for listening. Tell your friends. Please like and subscribe.